Hey everybody, welcome back to Drawbridge Finance. I'm pretty excited because it's almost Halloween and we have a costume party this weekend, which I'm always excited about. I love costumes. If you guys aren't familiar with my other channel, you should probably check it out. I'll put a link down in the description below, but it's called Drawbridge Props and Armory, and I build super cool things, and I especially love building Halloween stuff. Anyways, today's video is not about Halloween at all. It is about mortgages and whether or not we should pay them off. All right, let's get right into this. I've got another mortgage video for you guys today. And as always, I'm not a financial advisor. I don't work in the finance industry. I am not a professional by any means, but I am a longtime investor and I know how to do math. In fact, I love doing math. So today I'm going to use one of my custom charts that's available to my patrons or on my Etsy store. I'll put a link right up here if you guys are interested in becoming a patron of mine. Otherwise, you can check in the description below if you'd like to download these charts. And this one is the mortgage versus investing chart. So I'm just going to load it up. We'll take a look. There's 4 different spreadsheets that come with this. And so the most of the information gets entered in the summary page. So we'll take a look at that. And this is actually real life information. One of my longtime subscribers just contacted me the other day and they just kind of wanted to reiterate what they were thinking about making a payment to their mortgage. Now their situation is pretty interesting. Basically, they just bought a house. I guess they just moved into it this month, so in October. And at the same time, they had an unfortunate family incident, which has left them with an inheritance. And interestingly enough, the inheritance is slightly more than their new mortgage. Now, this is an interesting situation because here in Canada, it's not easy for us to just pay off our mortgages all the time at once. We have to abide by the rules of the bank. And in most cases, there's a maximum amount of money that we can put towards a mortgage. So even once they get this inheritance, they are not going to be able to pay off their mortgage in entirety. But what it really leads them to thinking is whether or not they should be putting any money towards that mortgage. And it's a really interesting scenario. So looking at what they could do a lump sum payment of up to 10% of the total value of their loan. So their total loan, which is brand new, is $250,000. And it's at a rate of 2.98% annually, amortized over 25 years. Now, of course, in Canada, our rates get negotiated at an interval, so they can be on a fixed term for a couple of years. Now, I'm going to just disregard that. We'll just look at the numbers for the whole 25 years and just say, okay, what if we renew at this 2.98%? Or because if they keep the money, at some point when they're up for renewal, they will be able to pay off the mortgage in entirety with this inheritance, which was $260,000. So basically, they have $250,000 loan at 2.98%. They have $260,000 coming to them in cash. And they have this maximum that they can currently put towards the mortgage. So should they put in the maximum? Should they put in zero? Or should they put in somewhere in between the maximum and zero? And so I want to run 3 different scenarios, and I'm going to use this chart to look at that. So the very first thing we do is look at the summary page. We're going to put in the amounts. I've already done it. Filling in the white cells, $250,000. The interest rate is 2.985%, and the term's 300 months. So the regular monthly payment is going to be $1183.58, and the extra monthly payment, we're just going to leave it 0 for right now. Now, if we go up to the top in numbers or the bottom, if you're using the Excel version, both are available. Then we just look at, we've got A, B, and C allows us to do custom payments. So at the outset here, we've got the gray portion of this chart, and that shows what the mortgage would be just regularly. So we can see the payment of $1183, $621 goes to interest, and the principal is $561. Now I want to reiterate the fact that these cells highlight in red when the principal payment is less than the interest. It means that more than half of the payment every month is going towards interest. And I personally, I think that's kind of the breaking point for most mortgages. Once you get to that point where your normal payment is most of it's going to principal and less of it is going to interest, that's when you're like really starting to make money off your mortgage. And so there's kind of this like ideal point for that. And that's going to become important. Okay, so now we've got 2 columns. And we've got the mortgage here, and then we've got the investments, and then the net worth. So without doing anything, I'm just going to scroll down to the bottom, and you guys can see what the default values are. So the net worth at the end of this is $250,000 if they just make their payments every month. Now the idea is that they can take the $260,000, and we're going to say this investment value is starting at 0. They're going to take the $260,000 and they can put the whole thing towards their investment. So let's see what that value works out to. Let's say $260,000. Of course, what they're going to want to do is, because they have that money, they're going to want to use that money every single month to make their mortgage payment. So what we're going to do is we're going to take a withdrawal from the investment account that is equal to the payment amount. So I'm just going to manually type this in. I'm going to put in negative 1183.58. And so that payment will be coming out of their investment and going into their mortgage. So effectively, they never have to make a mortgage payment again out of their regular checking account. Then what we're going to do is I'm just going to drag this down. Now, this is only going to be affecting the investment side. I'm going to drag this right down to the 300 month mark. So as you can see, I've picked this month 300, and that is when the final mortgage payment will be made, and the last payment will come out of the investment. Now let's scroll down to the bottom to see what the net worth is. So the net worth is $344,876. Now that's compared to the $250,000 that they were going to have before. So they've increased their net worth by about $94,000. Now you're going to say, well, what is the percentage that we're looking at? Right now we're looking at an estimated annual dividend of 4.8%. Now the reason I use 4.8% is because just this morning I made a post to all my patrons showing them a dividend stock that I'm buying that is a 4.8% return. And that's annually. The best thing about that stock is I actually see upside potential, maybe like 60, 70, 80% gains on the actual investment itself, regardless of the dividend, over the next 2 years. This is a company that I've invested in for a long time, and they are very much in an uptrending phase for these next couple of years. You can check that out on my Patreon. Just go over there. Again, the link's down below. I'll put the link up here somewhere, and you guys can check out all of those trades if you're interested. So that's why I'm using this annual dividend of 4.8%. I've also included the capital gains. Now, the capital gains in Canada maxes out at 21.5% because that's half of the 43% that we pay for maximum income tax bracket. Now in the States, capital gains are taxed a lot less. It would be like 15% if we were doing this in the States. So this does account for capital gains, and it's calculated monthly. So keep this number in mind, $344,876, because that is kind of the best case scenario. So now let's do something different. Let's do a little juggle. So they can pay up to 10% extra payment to their mortgage. So they could put in $25,000 here. So that would bring this investment contribution down by that $25,000. So I'm going to change that to $235,000, and the payment will still be coming out of their investment account and going towards the mortgage. So they still aren't really making a mortgage payment anymore. They're just paying it from their investment account. Now, the thing is, by doing this, they've made this extra payment to their mortgage, $25,000. That's going to mean they're going to pay off their mortgage a lot sooner, which means they'll have to stop making payments sooner. So let's scroll down and find the month that their mortgage stops being paid. And here it is. So 258. So they've shaved 42 months off their mortgage. So now what we need to do is, obviously we don't have to make the payments on this side out of the investment anymore. So I'm going to delete all of these payments, and I'm going to adjust this last one to match the number right here in this payment amount. So that's going to be negative 989. All right, so now the numbers match. Now let's scroll down to the bottom. We can see the net worth is 332. Before we had 344. So this is slightly less, about $12,000 less in gains. And the biggest difference here is always between the percentage difference. The investments are making on average a 4.8% return, and the interest rate is only 2.98%. So obviously money invested into a product that is going to make a bigger reward than the interest being paid on a loan is going to make more money than the loan itself. Now, there's a lot of my subscribers feel good about having their mortgage payment paid off. And I too, like in the first year of my mortgage, I was making extra payments. Even though I know I can make more money on the stock market, it feels good to get those payments down, reduce the interest. And in the long term, I know that making those payments early in my mortgage is going to greatly reduce it later on. So if we have a couple of bad years in the stock market, I know that I've safely set aside that money by investing into my mortgage when I did. So now let's just do a different approach to this. I'm going to delete the 25,000. And what I'm going to do is look at this column. Now this principal portion is less than the amount going to the interest. And remember, I said that, like, for me, that's a bit of a benchmark. So what I want to know is how much money do I have to put into this account to bring that down? What if I put 10,000? Oh, there's still a couple of months there. What if I put $11,000? Well, that is pretty damn close. We got $3 difference there. $11,000 and then $12,000. $2 different there. So $12,000, that seems to kind of be the breaking point, is $12,000, which means that when the regular payment comes out of the investment account, more than half of it goes to the principal. The principal in this case will be $592 and interest will be $590. I personally think that is an amazing way to look at mortgages. I really like this kind of the graphical idea of being more of my money each month is going to the principal than is going to the bank. I've changed this amount, so we're going to have to increase the number of payments. We've actually increased the term of the mortgage again. So I'm going to go here and I'm going to drag these payments down, back down to equal. Okay, so now looking across, and then this last payment is going to be negative $247.92. Now, of course, this is just an estimate. The bank's paperwork is totally specific, and there are other charges and things they kind of sneak in there all the time. So you have to look at your own paperwork. But this is a guide to kind of give you an idea of what we can do with our money to make sure that we're making the most of it. All right, let's take a look. So here we would have $298,000. We are substantially reducing our money, but we're also taking away a little bit of the risk. By putting that $12,000 towards the mortgage, we are absolutely guaranteed saving that 2.98%. And over the course of 25 years, it's about $46,000 difference. Now, for some people, that is worth it. Even myself, I like to make those couple of little extra payments in that first year because I know what a huge difference it makes down the road. And I also know that it is inevitable that with investments, there are going to be down years and there's going to be up years. And so we always have to take that risk into consideration. Anyways, that's my thoughts for today. I hope you guys enjoyed it. Remember to hit that like button down below. Subscribe if you don't already, so we can all get rich together. Thanks so much for watching.